Chances are your financial advisor has told you to trust the 60-40 portfolio. And for decades, that was fantastic advice. Your parents, your grandparents, they probably built their wealth on a simple mix: 60% in stocks for growth, 40% in bonds for safety. It was the gold standard. It was the very bedrock of retirement planning. However, if you followed that advice in 2022, you saw something completely different that wasn't supposed to happen. You actually lost money on your stocks and you lost money on your bonds. A globally diversified 60-40 portfolio fell by about 16% that year, and some measures show it was even worse. The one part of your portfolio designed to be all weather, to help you to weather a storm, actually sank right alongside the ship. Now, you've probably heard that the 60-40 is making a comeback, and it's true. It bounced back in 2023 and through 2024, but focusing on that rebound misses the entire point. The 2022 crisis revealed a fundamental flaw in that strategy, a crack in its foundation. The old playbook showed it can actually fail. In this video, I'm going to show you a more modern approach to asset allocation, one that actually provides real income in a downturn, so you don't have to sell your stocks at the worst possible time when they're down 10, 20%, and most importantly, without sacrificing your long-term growth potential. So let's start by talking what exactly went wrong. Why did a strategy that worked for nearly half a century suddenly fail so spectacularly? Well, the whole idea behind the 60-40 portfolio hangs on one simple concept: negative correlation. When stocks zig, bonds are supposed to zag. And during a stock market panic, investors have historically fled stocks so they can go to the safety of things like government bonds, pushing those prices up. So that bond rally would cushion the blow that happens from falling stocks, acting as a shock absorber for your portfolio, which is exactly what you're looking for. And for decades, this relationship mostly held up. But in 2022, the game absolutely changed. We got hit with the highest inflation we've seen in 40 years. And to fight it, central banks launched the most aggressive rate hiking cycle in a generation. And this created the perfect storm. Rising interest rates are poison for existing bonds. Think about it. I mean, if a new bond is issued with a 5% interest rate, the old bond you're holding that only pays 2 or 3% suddenly looks a lot less attractive. So its price, if you wanted to sell it, has to come down so it can compete. And at the same time, those high interest rates, coupled with recession fears, absolutely hammered the stock market. And for the first time in a long time, the negative correlation that was the heart of the 60-40 portfolio, it broke down. They actually were positively correlated. Stocks and bonds fell together, and investors had absolutely nowhere to hide. The crisis of 2022 showed us that the very conditions that broke the 60-40, namely high inflation forcing interest rates up, can happen. So relying on the old model is like using a 50-year-old map to navigate a brand new highway system. The biggest problem, the one almost nobody talks about, is that for most of your investing life, that 40% in bonds can act as a drag on your performance. The 60% in stocks is what really drives your long-term growth. So we've been told to accept decades of lower returns on that 40% for the promise of protection in a bear market. Protection that, as we saw, isn't always guaranteed. This is the core problem. We've been shoehorned. Financial advisors have shoehorned us all just because they read this in a textbook 20, 30 years ago. We've all been shoehorned into a one-size-fits-all solution that, quite frankly, is archaic, and it sacrifices growth, the growth of our money, for a safety net that actually has some pretty serious holes in it. Now, you must be asking yourself, what if there is a better way? What if, instead of blindly dedicating 40% of your entire portfolio to an asset that's going to reduce and drag down your overall returns, you could create a personalized safety net that works for you specifically, one that's perfectly sized for your life, which gives you the protection you need without kneecapping the growth required for you to build long-term real wealth. This isn't about some magic new asset. It's about changing the question we're asking. It's about approaching asset allocation with a completely different mindset. The old question was, what percentage of my portfolio should be in bonds? The new, smarter question is, how much cash do I need to survive a bear market without being forced to sell my stocks when they're down 10 to 20%, which most financial plans will tell you is the number one thing that ruins a financial plan. When somebody is forced to sell their stocks in a bear market to meet their income needs that they might have in retirement. The answer to that question is the real solution. It's an approach that we call a bucket strategy, where we're looking at your lifestyle bucket, and I call it the income deficit method. And it's going to completely change how you think about your portfolio. Now let's dive into the income deficit method. This method is incredibly powerful because it's based on you, your life, your expenses, your income, not some arbitrary, outdated rule that financial advisors read out of a textbook 30 to 40 years ago. This is a simple 4-step process. The first step is you need to calculate your annual living expenses. You need to know exactly how much money it takes to run your life for 1 year. And I mean everything. I'm talking about your mortgage, your rent, your property taxes, your groceries, utilities, car payments, insurance, and then discretionary items like travel and fun. I want all of it added together. But be honest and be thorough. So let's just hypothetically say that number's $80,000 a year. And we'll come back to that later as I run you through an example. Step 2 is you need to add up all of your income. So you add up all your sources of income you could count on even in a deep recession. Assuming you work in a job that would be safe in a recession, please add in your salary or wages. In addition to that, add in things like Social Security, pensions, maybe rental properties. And if you add in rental properties, you might want to stress test that cash flow a little bit and maybe ratchet it down to 80-ish% of what you would normally expect to receive in rent. So continuing with our example, let's say you have a pension that pays $25,000 a year and your spouse brings in 15 grand from a reliable side business. So your total reliable income is 40 grand a year. We'll come back to that. In step 3, calculate your annual income deficit. And that's the most important number in your financial plan because that is how we arrive at the ideal asset allocation for you. All you have to do is subtract your income sources from your expenses. So let's go back to the example that we've begun setting up. So you have $80,000 a year in expenses minus the $40,000 in reliable income that you assume is going to come in. That equals an annual income deficit of $40,000. And that's the amount of money your portfolio needs to cover every single year during a downturn, so you don't have to sell a single share of any stock that might be trading at a loss, 5, 10, 20, even 50% down. Step 4, you need to build your bear market survival fund. So, how many years of that deficit, that income deficit, should you hold in safe liquid assets? Well, historically, the average bear market lasts maybe 9 to 15 months, but the full recovery, the time it takes for the market to get back to its previous peak, to go from peak to trough and regain its previous peak or get back to break even, that can take a little bit longer. If you go back and you study all bear markets going back to 1950, on average, it takes the S&P 500 about 1.7 years to fully recover. Now, some of the worst crashes, when they tend to be financial crises, like the dot-com bust or the 2008 financial crisis, they take a little over 4 years to get back to break even. So, to be prudent and to sleep well at night, a conservative plan is to hold maybe 4 to 5 years worth of your income deficit in safe assets. So in our example, if we take that $40,000 annual deficit and we multiply it by 5 years, because we're a little more conservative, that would give us $200,000, okay? That's the answer. That's your number. You need $200,000 in your bear market survival fund, held in safe places like short-term treasuries, corporate bonds, high-yield savings accounts. Everything else, every single other dollar that you have can be invested for growth in stocks, alternative assets, whatever it might be. That's super important. So it doesn't matter if your portfolio is $1 million or $5 million or $10 million in that example I just provided. The amount of money you should hold in those safe assets doesn't change. It's still $200,000. All right, so let's see how this actually plays out in a real world comparison. So Let's look at two different investors. Let's assume they're both 55 years old. They both have a $1.5 million portfolio. Investor A follows the old 60-40 rule. So his allocation is pretty simple, 60% in stock. So he's got 900 grand in a growth vehicle and 40% in bonds, which is a whopping $600,000. And that 600 grand is sitting in lower return assets, acting as a constant drag on his potential growth, all for the sake of safety, because the textbook tells you you need to have 40% in bonds. Now, meet investor B. She uses the income deficit method. Her expenses and income are the same as our example, so the annual deficit is $40,000 a year. She wants a 5-year safety buffer, so she needs a bear market survival fund of $200,000. So she puts 200 grand into safe liquid assets. The rest of her portfolio, the entire 1.3 million, can now be invested for growth. So look at the difference. Investor A has 900,000 in growth investments. Investor B has 1.3 million in growth investments. That's an extra 400 grand compounding for years and years and years, maybe even decades. So the difference in their final net worth could be absolutely staggering. Now, will Investor B's portfolio be more volatile on a day-to-day basis? Absolutely. But her cash fund allows her to completely ignore that volatility. When the next bear market hits, she's protected. She has 5 years of those living expenses already covered in a safe bucket. She feels no panic, no anxiety. She has zero pressure to sell her stocks when they're down 30%. She can ride out the storm completely confident in her plan, while Investor A is watching both his stocks and his bonds lose value, wondering if his outdated strategy is actually going to hold up. So this approach gives you the best of both worlds: concrete, personalized safety combined with optimal long-term growth. This is a fundamental shift in how to think about asset allocation. It's moving from a rigid one-size-fits-all percentage, 40%, to a flexible, personalized solution built for you and your lifestyle. It's how you solve for the real risk, which is running out of cash in a downturn and then being forced to sell your stocks while they're beaten up. That can cripple your financial future. You know, for too long, the conversation about asset allocation has been stuck way in the past. The idea that you have to sacrifice huge amounts of future potential growth by holding a massive permanent chunk of your money in bonds, it's simply no longer the only or the best option. The world has changed, the markets have changed, and it's time for our strategies to change as well. If you got value from this breakdown, hit that subscribe button, like this video, turn on the notification bell so you can be alerted every time we come out with new valuable content. Calculate your expenses, identify your income, find your annual deficit, and build a survival fund that covers you for 4 or 5 years. If you focus on your income needs, you can build a portfolio that's truly resilient, one that actually protects you from panic selling in a crash, while also unleashing the full power of your capital to grow as fast as it can for the long term. And that is the real asset allocation solution. And before you go, let me know in the comments below, what is the single biggest question you have about building your own portfolio? I read every single one of these. Thanks for watching.